Before we dive in, a quick but important disclaimer. I am not a licensed insurance agent or financial advisor. This video is for educational and informational purposes only. The information provided is based on personal research and experience. Always consult with a qualified professional and read the full policy details before making any insurance decisions. Imagine this for a second. You're in Thailand, riding a scooter down a beautiful coastal road. The sun is warm, the air smells like salt and street food. It's the trip you've been dreaming about for years. Suddenly, a stray dog darts into the road. You swerve. The next thing you remember is waking up in a small foreign hospital. You have a severely broken leg and the doctor through a translator is explaining you need surgery. Then the hospital administrator hands you a bill. They need $50,000 up front. Before they'll even schedule the operating room, you pull out your wallet, your hand shaking, and show them your Blue Cross, your Aetna, your United Healthcare card. The administrator just looks at it, shakes their head and says, "We don't take this." That terrifying scenario isn't an exaggeration. It happens to Americans every single day. And the single most dangerous misconception we have as U.S. travelers is that our domestic health insurance will protect us when we leave the country. For over 90% of plans, it's basically a worthless piece of plastic the moment your plane's wheels leave American soil. Your employer-sponsored PPO? Probably not. Your marketplace plan from the ACA? Almost certainly not. And Medicare? Forget about it. With very few, very specific exceptions, Medicare offers zero coverage outside of the United States. This leaves you completely exposed to a world of healthcare costs that can be just as brutal as our own, and sometimes worse. A simple case of food poisoning requiring an overnight hospital stay in Mexico could set you back $5,000. A heart attack in Japan? You're looking at a bill well over $100,000. And the ultimate nightmare scenario, a medical evacuation, where they have to fly you home on a specialized plane with a medical team, can easily cost $250,000. That's not a vacation expense. That's a life-altering, bankrupting catastrophe. So the solution is obvious, right? Just get travel insurance. But that's where the real problem begins. You go online, you type in travel insurance, and you're hit with a tidal wave of comparison sites, confusing jargon, and dozens of plans that all look the same but have wildly different prices. You see terms like primary versus secondary coverage, pre-existing condition look-back periods, cancel for any reason, and hazardous sports rider. It's a minefield designed to confuse you. And the insurance companies? They are counting on you to be confused. They're counting on you to just pick the cheapest plan, or the one with the fanciest logo without ever reading the fine print. And that's how people get burned. They think they're covered, only to find out after a crisis that their $10,000 emergency room bill is denied because they went hiking, which was considered a hazardous activity, in a clause buried on page 37 of their policy. Or they discover their plan won't cover their asthma, a pre-existing condition they've had their whole life. This is where that stops. The purpose of this video is to give you a rock-solid step-by-step framework to compare any travel health insurance plan like an absolute pro. By the time you're done watching, you will know the exact questions to ask, the critical red flags to look for, and the hidden clauses that can financially ruin you. We are going to demystify the jargon, break down the different types of coverage, and I will show you the exact process I use to ensure I am protected on every single trip I take. You will be able to confidently choose a plan that actually has your back, without overpaying for fluff you don't need. So let's build your foundation. The very first and most critical step in this whole process is understanding that travel insurance is not one thing. It's a broad term for two fundamentally different types of products. Getting this one distinction right from the start will save you a world of headache and confusion. The first type is what most people think of, a comprehensive travel insurance plan. Think of this as the Swiss Army knife of travel protection. It's an all-in-one package. Its primary job is to protect the financial investment you made in your trip. It includes trip cancellation coverage, which reimburses you if you have to cancel your trip for a covered reason before you even leave. It has trip interruption coverage, which helps you if something goes wrong mid-trip and you have to cut it short. It also usually includes coverage for lost luggage, travel delays, and other logistical nightmares. And yes, bundled inside this big package, there is also a travel medical insurance component for emergencies. This is the plan you buy when you've just dropped $10,000 on a non-refundable African safari or a European cruise and you're worried about losing that money. The second type is a travel medical insurance plan. This is not a Swiss Army knife. This is a surgeon's scalpel. It is lean, focused, and designed to do one job with extreme precision. Protect your health and your savings from a medical disaster abroad. These plans have little to no trip cancellation or baggage loss benefits. They are laser-focused on high-limit emergency medical and dental coverage, and most importantly, emergency medical evacuation. This is the plan for digital nomads who are gone for 6 months, backpackers on a budget, or even someone taking a last-minute trip to the Caribbean who isn't worried about losing the $500 they spent on their flight, but is terrified of a $100,000 helicopter ride to a hospital in Miami. Choosing between these two isn't just a minor detail. It is the most important decision you will make. It dictates everything that follows. If you're a 25-year-old backpacker with no prepaid expenses, buying a comprehensive plan means you're wasting money on trip cancellation coverage you literally cannot use. Conversely, if you're a family of 4 heading on that expensive cruise, a simple travel medical plan won't do a thing to help you if one of the kids gets sick a week before, and you have to cancel the entire vacation. Picking the wrong type means you are either paying for coverage you don't need or, far worse, you're completely exposed in the one area you thought you were protected. So, the big question is, how do you decide? How do you know if you need the Swiss Army knife or the scalpel? To answer that, you need to honestly assess 3 critical things about your trip, your health, and your money. And the first question we need to tackle is the one that trips up almost everyone. What's the difference between your destination and your coverage area? That sounds like semantics, right? A trick question. But I promise you, the answer to this question can be the difference between a fully paid $50,000 medical bill and a lifetime of debt. Your destination is the place you type into Expedia. It's Rome. It's Tokyo. It's Costa Rica. Your coverage area is the list of places the insurance company is actually willing to help you. And they are not always the same thing. Think about it like your cell phone plan. You might live in Ohio, but you have coverage across the United States. Travel insurance works the same way, but with far more dangerous loopholes. Most policies sold to Americans will cover you almost anywhere in the world, but they often have a list of specific and sometimes surprising exclusions. These are countries where, if you get hurt, you are on your own. This list often includes countries with a level 4 do not travel advisory from the U.S. State Department. So, if you're planning a trip to a place that's even slightly off the beaten path, your first step isn't to look at price. It's to find the policy's geographical exclusions list and make sure your destination isn't on it. But the most common trap isn't some war-torn nation. It's right here, the United States. Almost no international travel health insurance plan will cover you in your home country. This makes perfect sense. It's travel insurance, not your domestic health plan. But here's where it gets messy. Imagine you're on a 6-month backpacking trip through Southeast Asia. 3 months in, your sister announces she's getting married back in California. So you book a flight home for 2 weeks to attend the wedding before flying back out to continue your adventure. The day after the wedding, you're playing a pickup game of football with your cousins, and you tear your ACL. You're in an American hospital, facing an American-sized bill for surgery. You think, thank God I have my travel insurance. You file a claim. Denied. Why? Because you were in your home country. Your travel insurance was effectively paused the moment you landed on U.S. soil. You needed your regular U.S. health insurance, which, if you're on a long trip, you might have let lapse. It's a brutal lesson that thousands of travelers learn the hard way every year. And the geographic traps don't stop there. Let's say you're spending a month in southern Spain. One weekend, you and your friends decide to take a ferry over to Morocco for a couple of days. You're still on your trip, right? You're just taking a little side quest. But is Morocco included in your policy's coverage area? Many plans are sold on a regional basis: Europe, South America, Southeast Asia. If your Europe plan doesn't explicitly include Northern Africa, that weekend trip to the markets of Tangier could be a gamble you can't afford to lose. Before you cross any border, even for a day, you need to know with 100% certainty, am I still covered here? So that's the where. But it's only half the equation. The other, even more critical question you have to ask is, what will I be doing there? Because buying insurance without considering your activities is like packing for Alaska with nothing but swim trunks. Let me tell you about a couple named Mike and Jenna. They were in their late 20s, active and excited for the trip of a lifetime. 2 weeks in Peru, culminating in a visit to Machu Picchu. They did everything right. They booked their flights, their hotels, and they bought a travel insurance plan from a reputable company. It wasn't the cheapest, but it had good reviews and a high medical coverage limit. They felt secure. They spent the first week exploring Lima and Cusco, adjusting to the altitude. Then they got to the main event. But instead of just taking the train and bus up to the famous ruins, a guide convinces them to do a one-day short version of the famous Inca Trail. It's a bit of a challenging hike, but they're in good shape. It'll be an adventure. About 5 hours into the hike on a steep stone-paved section of the trail, Jenna's foot slips on a loose rock. She feels a sickening pop in her ankle. The pain is instantaneous and blinding. She can't put any weight on it. They're miles from any road at over 9,000 feet. The guide makes a call on his satellite phone. The only way to get her out is by helicopter. The evacuation alone costs $18,000. At the clinic in Cusco, an X-ray confirms a trimalleolar fracture, a severe break in 3 different places on her ankle. It requires immediate surgery, plates, and screws. The total bill, including the flight, the surgery, and a week in the hospital, balloons to just over $47,000. Back in their hotel room with Jenna's leg in a massive cast, Mike pulls up their insurance documents. He's stressed, but he feels a wave of relief. Their policy covers up to $100,000 in medical emergencies and up to $500,000 for medical evacuation. They're covered. They'll be fine. He files the claim, submitting all the detailed hospital bills and the evacuation invoice. A week later, he gets an email. The subject line: regarding your claim. He opens it. His heart sinks. The claim was denied. All $47,000 of it. Why? He frantically reads the fine print. Buried deep in the policy document, under the exclusions section was a single clause. The policy covered recreational hiking on marked trails, but it specifically excluded any activity defined as mountaineering. And how did they define mountaineering? Any trekking or climbing at an altitude above 3,000 meters, that's about 9,800 feet. The spot where Jenna fell was just over that limit. To the insurance company, the moment they stepped over that invisible line in the mountains, they might as well have been jumping out of a plane without a parachute. Their policy was void. Their adventure had turned into a catastrophic financial burden. Mike and Jenna's story isn't an outlier. It happens every single day. Someone buys a policy thinking it covers a trip to Thailand, but doesn't realize it excludes scooter rentals, which is how most people get around the islands. Someone else buys a plan for a ski trip to the Alps, but doesn't realize it only covers skiing on piste, and their accident happened 10 feet into the powder on the side of the marked run. You cannot just assume you're covered. You have to know. So before you even look at a single comparison website, you need to do a brutally honest risk assessment of your own trip. Grab a piece of paper or open a new note on your phone. First, make a list of every single country you plan to visit or even might visit. Include long layovers where you might leave the airport. Include every potential side trip. Second, make another list. Write down every single activity you plan to do. And don't just write sightseeing. Be specific. Are you going to be riding a scooter? Snorkeling? Going on a multi-day hike? Taking a cooking class? Going scuba diving? Even if you don't have a certification, will you do a discovery dive? Will you be skiing or snowboarding? Going rock climbing? Riding a horse? The more honest and detailed you are with this list, the more power you have. These 2 lists, your locations and your activities, are your filter. They are the lens through which you must view every single policy. When you start comparing plans, your first move won't be to look at the price or the deductible. It will be to open the full policy wording, hit Ctrl F and search. Search for the name of your country. Search for the word scuba. Search for altitude. Search for motorcycle. If the policy excludes your destination or your must-do activity, it is worthless to you. Close the tab and move on. So you've mapped out your trip's risks. You've got your list of countries and activities. You think you're ready to start comparing plans, but you're not. Because the most expensive variable in this entire equation isn't the helicopter ride off a mountain in Peru. See you. And there's one question about your own health that can invalidate your entire policy if you get it wrong, even if you think you're being completely honest. That question, the one that can torpedo your entire safety net, is this: do you have a pre-existing medical condition? Now you might be thinking, that's easy. I'm healthy. No. Or maybe, yeah, I have high blood pressure, but it's totally under control with medication. So no big deal. And that is precisely how thousands of travelers get their claims, sometimes for hundreds of thousands of dollars, denied. Because what you think a pre-existing condition is, and what your insurance company defines it as, are 2 radically different things. And in this game, their definition is the only one that matters. Let me tell you about a guy we'll call David. David is 62, recently retired, and about to take the trip of a lifetime with his wife. A 3-week culinary tour of Vietnam. He's in decent shape, but like a lot of guys his age, he's on a daily statin for his cholesterol and a low-dose pill for blood pressure. It's been the same prescription, the same dosage for 5 years. He feels great. When he buys his travel insurance, he sees the question about pre-existing conditions. He thinks, well, my blood pressure is stable, it's not a problem. He might check yes, but assume it's covered because it's so well managed. 2 weeks into his trip, after a fantastic bowl of pho in Hanoi, David feels a crushing pain in his chest. He's having a heart attack. He's rushed to a private international hospital, gets top-notch care, a stent put in, and thankfully he survives. The bill comes to $90,000. No problem, he thinks that's what the insurance is for. He files the claim. A week later he gets an email. Claim denied. Why? Because when the insurance company's investigators requested his medical records, and trust me, for a claim that big, they saw something. 3 months before David bought the policy, he'd gone to his doctor for a routine checkup. He mentioned feeling a little more tired than usual. His doctor, being thorough, decided to switch him from one brand of blood pressure medication to a generic version to save him some money. It was the exact same drug, the exact same dosage, just a different manufacturer. To the insurance company, that tiny, insignificant change, a change in medication within their look-back period, meant his pre-existing condition was not considered stable. And because it wasn't stable, it wasn't covered. David was on the hook for the entire $90,000. His retirement dream trip turned into a financial nightmare. This is the minefield you have to navigate. It's not about dishonesty. It's about definitions. Let's break down the 3 secret terms you absolutely must understand. The look-back period, the stability clause, and the Holy Grail. The pre-existing condition exclusion waiver. First, the look-back period. This is the sneakiest, most important piece of fine print. Every policy has one. It's a set window of time, usually 60, 90, or 180 days, before you purchase the insurance. The insurer will look back at your medical history during this period. And here's the critical part. They aren't just looking for a new diagnosis. They are looking for anything related to a condition. A new symptom you mentioned to your doctor, a change in medication like David had, a recommendation for a new test even if you never got it done. If you had an undiagnosed pain in your knee a month before you bought the policy, and then you tear your ACL on a ski trip in the Alps, they can argue that the pain was a symptom of a pre-existing condition, and deny your claim for knee surgery. What matters isn't what you know. It's what's in your medical records. Second, the stability clause. This is the partner in crime to the look-back period. Most policies will cover pre-existing conditions if they are stable. But stable has a very strict definition. It generally means that in the last 60 to 180 days, you have not had any new symptoms, your condition hasn't gotten worse, and there have been no changes to your medication, no new prescriptions, no adjustments in dosage, not even a switch to a generic like David. Think about that. Have you had your asthma inhaler dosage tweaked? Did your doctor up your cholesterol meds? Did you mention a fleeting headache during a checkup? Any of these things can render a condition unstable in the eyes of an insurer, giving them the perfect excuse to deny your claim. So, how do you protect yourself from this? You feel like you need a medical degree and a law degree just to go on vacation. This brings us to the single most important feature you should look for in any travel insurance plan. The pre-existing condition exclusion waiver. This sounds complicated, but it's beautifully simple. It's a benefit that says, we will waive the exclusion for pre-existing conditions. It means the look-back period and the stability clause essentially vanish. It means if you have a flare-up of a chronic condition, a heart attack related to your known high blood pressure, or a complication from your diabetes, you are covered. This waiver transforms a policy from a gamble into genuine protection. It's the difference between hoping for the best and being truly insured. But, and this is a massive but, there's a catch. You can't just add this waiver whenever you want. Insurance companies are not in the business of letting you buy fire insurance when your house is already on fire. To get this waiver, you almost always have to buy your insurance plan within a very specific, very short window of time, typically 14 to 21 days after you make your initial trip payment. That first payment could be your flight, your cruise deposit, or your tour package. The clock starts ticking the second you put that first dollar down. If you wait a month to buy your insurance, you've missed the window. The waiver is off the table, and you are fully exposed to the dangers of the look-back period and stability clause. This is why the advice to buy your travel insurance right after you book your trip isn't just a suggestion. It is the most critical financial move you can make for your travels. So what's the game plan? Step 1. As soon as you book that flight or pay that deposit, start shopping for insurance. You are now on the clock. Step 2. When you compare plans, make finding one with a pre-existing condition exclusion waiver your number one priority. It is more important than the baggage delay amount or the rental car coverage. This is the core of your medical protection. Filter for it. Hunt for it. Do not settle for a plan without it, especially if you have any ongoing health concerns at all. Step 3. Read the requirements carefully. Make sure you are buying the plan within the required time frame, usually 15 or 21 days from your initial trip payment. You also need to ensure the full, non-refundable cost of your trip for the waiver to be valid. Don't try to save a few bucks by underinsuring your trip costs, or you could invalidate the most important part of the policy. Getting this right is everything, because the most expensive medical event isn't the one that happens out of the blue. It's the one that's connected, even by the thinnest thread, to something in your past. By securing that waiver, you sever that thread. You're taking control of the definitions and ensuring that the policy you bought is the policy you actually have. Now you've found a plan with the waiver. You've bought it in time. You feel secure. But there's another trap waiting. And this one has nothing to do with your health. It has to do with your other insurance, your health insurance from back home. Because how your travel policy interacts with your domestic plan can be the difference between paying a small deductible or paying the first $25,000 of a medical bill yourself. And it all comes down to two little words: primary versus secondary. These two words are the most important, most overlooked, and most financially dangerous terms in the entire world of travel insurance. And understanding the difference will arm you with the single most powerful piece of knowledge for protecting yourself abroad. Let's think of it like this. Imagine your healthcare is a baseball team. Your regular health insurance plan from back home, the one you use for doctor visits and prescriptions, that's your starting pitcher. He's your go-to guy for all your regular season games. But when you travel internationally, you're playing in a totally different league, a championship game in a foreign stadium with different rules. You need a special pitcher for this game. A primary travel insurance policy is like bringing in a new, elite starting pitcher specifically for this away game. The moment something happens, he's on the mound ready to go. He takes control of the situation immediately. He doesn't ask what your other pitcher is doing. He is the first and only line of defense you need. A secondary travel insurance policy is a relief pitcher. He sits in the bullpen warming up, but he refuses to enter the game until your original starting pitcher, your health plan from back home, has either won, lost, or been completely exhausted and taken off the field. He only comes in after the primary player has done their part. And that is where the nightmare begins. Let's imagine a traveler. We'll call her Sarah. Sarah is 32 years old. She works in marketing, and she's saved up for 2 years for her dream trip to Italy. She has a good PPO health plan through her job in the States. Before she leaves, she does the responsible thing and buys a travel health insurance policy. She finds one online that looks great. It's cheap, only $90 for her 2-week trip, and it advertises up to $100,000 in medical coverage. She buys it, prints out the ID card, and feels totally protected. A week later, she's zipping through the beautiful, chaotic streets of Rome on a Vespa when a car cuts her off. She swerves, loses control, and comes down hard. The result is a broken leg, a bad, complex fracture that requires surgery. She's rushed to a local Italian hospital, in pain, scared, and unable to speak the language. After she's stabilized, a hospital administrator comes to her room with a clipboard and a concerned look. They explain that before they can do the surgery, they need a guarantee of payment. They estimate the bill will be around 30,000 euros. Sarah, relieved, pulls out her travel insurance card. "No problem," she says. "I have this." She calls the 24/7 assistance number. The agent on the other end is polite, but what he says next makes her blood run cold. He says, "Ma'am, I see your policy here. This is a secondary plan. That means you first need to submit this claim to your primary health insurance in the United States. Once they have processed the claim and paid what they're going to pay, or officially denied it in writing, you can then submit the remaining bills and their denial letter to us, and we will consider payment for what's left over." Let that sink in. Sarah is in a hospital bed in Rome with a shattered leg. Her travel insurer, the company she paid to protect her in exactly this situation, is telling her to first deal with her American insurance company, 6,000 miles and a 6-hour time difference away. So she calls her U.S. health plan. The agent is confused. A hospital in Rome? That's out of network. It's out of the country. We don't have any agreements with them. You'll have to pay the entire bill up front, get fully itemized receipts for every single thing, have them translated into English, and then submit them to us for reimbursement. We can't guarantee we'll cover it. And if we do, it will be subject to your out-of-network deductible and coinsurance. Sarah has a $7,000 out-of-network deductible. So now look at the situation. The Italian hospital wants 30,000 euros now. Her travel insurance won't pay a penny until her US plan officially denies the claim in writing. A process that can take weeks, even months. And her US plan won't even look at the claim until she's paid the entire bill herself. And even then, they might deny it or only reimburse a tiny fraction after she's paid her $7,000 deductible. She is trapped, stuck between two massive insurance bureaucracies, in a foreign country with a serious injury, facing a bill that could financially ruin her. This is not a rare, hypothetical scenario. This happens every single day. This is the brutal reality of a secondary insurance policy. It's a policy that promises to catch you, but only after you've already hit the ground. Now let's rewind. Let's imagine Sarah paid a little more for her policy. Maybe it costs $150 instead of $90. But this time she bought a primary plan. She has the same accident. She's in the same hospital. The same administrator asks for payment. She calls her travel insurance company. This time the conversation is completely different. The agent says, "Sarah, I'm so sorry this happened. Don't worry, you have a primary policy with us. We are on it. Let me speak to the hospital administrator right now." The travel insurance company immediately sends a guarantee of payment directly to the hospital. They open a case file. They have medically trained staff who can speak with the Italian doctors in Italian to monitor her care. They arrange for everything. Sarah doesn't have to call her US insurance company at all. She doesn't have to pay a single euro out of pocket, except for her small travel plan deductible, maybe $250. The travel plan handles the entire 30,000 euro bill. They become her advocate, her translator, and her financial guarantor. Her US plan is never even involved. She can focus on one thing and one thing only: getting better. The difference isn't just money. It's sanity. It's the difference between a manageable crisis and a life-altering financial and logistical nightmare. So why does anyone buy a secondary plan? Because they are always cheaper. And insurance websites often hide this crucial detail deep in the fine print. They'll flash the big, sexy $100,000 coverage number on the front page and bury the word secondary in paragraph 17, subsection B of a 40-page policy document. When you are comparing plans, this is the very first thing you must look for. Before you look at the price, before you look at the coverage limits, you need to find the section of the policy that describes how claims are paid. You are looking for specific language. If you see phrases like pays in excess of any other collectible insurance or coordinates benefits with your primary insurance, that is a secondary plan. Run away. If you see phrases like primary coverage, pays first, or this plan is primary to all other insurance policies, that is what you want. That is the gold standard. And this becomes even more critical if you have a high-deductible health plan back home, or if you're on a plan like an HMO that has zero out-of-network coverage. For those travelers, a secondary policy is effectively worthless. It's a ticking time bomb. The secondary insurer expects your primary plan to pay first, but your primary plan has no intention of paying anything for an out-of-country emergency. You're caught in a catch-22 that you will have to pay your way out of. Some people think, well, my regular health insurance says it has worldwide emergency coverage, so I should be fine with a cheap secondary plan. That phrase is one of the most misleading in the industry. As we saw with Sarah, coverage often just means the possibility of reimbursement after you've paid tens of thousands of dollars out of pocket. It doesn't mean they will coordinate your care. It doesn't mean they will talk to the foreign hospital. It doesn't mean they'll get you out of a medically inadequate facility. A primary travel plan does all of that. So the rule is simple, and it is non-negotiable. Your travel medical insurance must be primary. It may cost you an extra $50 or $100 on the premium, but that is the single best money you will ever spend to protect your trip, your finances, and your well-being. Sorting plans by primary versus secondary should be your very first filter, eliminating more than half of the junk policies out there immediately. So you've found a primary plan. You've dodged the biggest bullet. But now you see a new set of numbers: 50,000, 100,000, 500,000, even $1 million in medical coverage. How much do you actually need? Is $1 million of coverage just a marketing gimmick? Or is settling for $50,000 a dangerous, irresponsible gamble? Choosing the wrong number can be just as devastating as choosing the wrong type of plan, and the answer depends entirely on where in the world you're going. Let's start with the most expensive place on earth to get sick: the United States. If your travels bring you here, or even if you're just transiting through, a low coverage plan isn't a gamble, it's a guaranteed loss. A $50,000 policy might not even cover the ambulance ride and the initial ER visit in some major cities. Let's paint a picture. You're hiking in a national park in California, you slip, and you suffer a compound fracture in your leg. It's a clean break, but it's serious. First, you might need a search and rescue team, which can cost thousands. Then comes the ambulance ride, which can easily be another $2,000 to $3,000. At the hospital, you'll get an MRI, that's a few thousand more. The surgery to set the bone with plates and screws? You're now looking at $30,000, $40,000, even $50,000. And we haven't even talked about the hospital stay. An average night in a US hospital can run $5,000 or more. Add in the surgeon's fees, the anesthesiologist's fee, physical therapy. You can see how a simple broken leg can blast past $100,000 before you're even discharged. A more serious incident like a car accident or a sudden heart attack requiring intensive care can surge into the hundreds of thousands, even millions of dollars with terrifying speed. For this reason, if your itinerary includes the United States, Canada, or even places like Monaco or Switzerland, a coverage limit of less than $500,000 is frankly irresponsible. $1 million policy is not a gimmick here. It's a necessity. It's the baseline. It's the only thing standing between you and a lifetime of medical debt for an accident that took 5 seconds to happen. Okay, so what about other developed countries? Let's say you're heading to Western Europe, Australia, or Japan. These countries have fantastic healthcare systems, and they're not as astronomically expensive as the US. So, is a $50,000 or $100,000 plan enough here? Maybe. But maybe is a scary word when your life savings are on the line. Imagine you're in Rome, enjoying the perfect plate of pasta, when you suddenly feel a sharp pain in your side. Gets worse fast. You end up in a local hospital with acute appendicitis. You need emergency surgery. The care you receive is excellent, the doctors are wonderful. The bill comes and it's 20,000 euros. That's a lot of money, but your $100,000 policy covers it with room to spare. You feel relieved. But what if it wasn't appendicitis? What if it was a sudden brain aneurysm that required a prolonged ICU stay and complex neurosurgery? What if you developed a severe infection after the surgery, keeping you in the hospital for weeks, not days? Your bill could quickly swell to $70,000, $80,000, or $90,000. Now, that $100,000 limit is looking awfully tight. If any complications arise, you'll blow right past it, and you'll be paying the rest out of pocket. For these mid-cost regions, a minimum of $100,000 in coverage should be your starting point, but $250,000 is a much safer, more prudent choice. It provides a crucial buffer for complications or a more serious diagnosis. It's the difference between feeling secure and anxiously watching every single line item on your hospital bill, praying it doesn't cross that arbitrary line you chose to save a few dollars on your premium. Now we get to the most deceptive category, the so-called cheap countries. Think Southeast Asia, Central and South America, Eastern Europe. You can see a doctor for $20. A hospital stay might be a few $100s a night. So that $50,000 plan looks perfect, right? It seems like a savvy, cost-effective choice. This is the single most dangerous assumption travelers make, because the biggest, most catastrophic expense you can face has almost nothing to do with the local cost of healthcare. It has everything to do with the cost of getting out. I'm talking about medical evacuation. Let's say you're trekking in a remote part of Peru. You fall ill with a severe, unidentified infection. The local clinic is little more than a small room with a doctor who does their best, but they don't have the diagnostic tools, the medicine, or the specialists you need. You're getting worse. Your life is at risk. Your insurance company's emergency team agrees. You need to be moved to a state-of-the-art hospital in Lima, the capital city, immediately. That doesn't mean hopping on the next commercial flight. You're too sick for that. You need an air ambulance, a private jet staffed with a doctor and a nurse, loaded with life support equipment. The cost to charter that plane, staff it, and fly you from a remote airstrip to the capital can easily be $25,000 to $50,000. Just for the flight. Your entire $50,000 policy could be vaporized before you even check into the better hospital. And what if the care in Lima isn't enough? What if you need long-term specialized treatment back home in the United States? Now we're talking about medical repatriation. An international air ambulance flight crossing continents with a full medical crew can cost $100,000, $200,000, sometimes even more than $250,000. Suddenly, that cheap $50,000 plan seems terrifyingly inadequate, doesn't it? The low local hospital costs are irrelevant. The real risk isn't paying for a few stitches in Thailand. It's paying the cost of a small house to fly you out of the jungle when something goes horribly wrong. This is why, even in the cheapest countries in the world, a policy with at least $100,000 in medical coverage and crucially a separate high limit for medical evacuation, $500,000 or more, is the only sane choice. The evacuation coverage is your golden ticket home. Without it, you're trapped. But there's another sneaky trap hidden in the fine print, and it can make even a high-dollar policy feel worthless. You need to look for the difference between the overall policy maximum and the per incident or per illness limit. Many travelers see $1 million in coverage plastered on a brochure and think they're set. But buried deep in the policy wording is a clause that says the maximum they will pay for any single sickness or injury is, for example, $100,000. So, you have that serious car accident. Your total bills come to $250,000. You think you're fine because you bought the $1 million plan. But the insurance company points to the fine print and says they will only cover the first $100,000 because it was all part of a single incident. You are personally on the hook for the remaining $150,000. It's a bait and switch, and it's perfectly legal. When you compare plans, you must find a policy where the overall maximum is the amount they will pay for any one event. You want that full $1 million safety net to apply to a single catastrophic incident. A lower per incident cap neuters your entire policy, turning your high-limit coverage into a marketing illusion. It's a critical detail that could be the difference between complete protection and financial ruin. So the question isn't just how much coverage, but how much coverage for what? Always check that fine print. Your financial future depends on it. Now let's dive into that fine print. When you see a policy with a $1 million medical limit, what does that actually buy you? This is where we separate the good plans from the great ones. The first and most obvious benefit is emergency medical and dental. This is the bedrock of your policy. It covers the unexpected. A sudden case of appendicitis in Italy, a nasty fall from a scooter in Thailand, a severe allergic reaction in Mexico. We're talking about hospital stays, doctor's fees, surgeries, x-rays, and prescription medications needed to treat an acute illness or injury that occurs on your trip. Notice the key words: emergency, unexpected, acute. This coverage is not for a routine checkup, a teeth cleaning, or getting a second opinion on a condition you already have. The dental part especially is almost always misunderstood. It's not dental insurance. It's for emergencies only. Think you broke a tooth in a fall, or you wake up with a sudden, severe, abscess tooth that requires immediate treatment to relieve pain. That's what it's for. It's a patch-up job to get you out of pain and stable enough to see your own dentist when you get home. The limits are often low, maybe $1,000 or so, but when you're in agony in a foreign country, trust me, it's a lifesaver. But here's where the numbers get really, really big. The benefit that can single-handedly save you from a six-figure bill. It's called emergency medical evacuation. This is not the same as a local ambulance ride to the nearest hospital. This is about getting you from a place with inadequate medical care to a place that can properly treat you. Imagine this scenario. You're on a dream hiking trip in the Andes. You're miles from the nearest town. You slip and you suffer a complex fracture and a serious head injury. The local clinic is little more than a single room with a nurse. They can't handle this. They can't perform the surgery you need. They don't have a neurosurgeon. What happens now? With robust medical evacuation coverage, a single phone call to your insurance provider's 24/7 emergency line sets a massive logistical machine in motion. They consult with the local doctor and your doctor back home. They determine that you need to be moved. They might arrange for a helicopter to airlift you from the trail to a regional airport. From there, they could charter a private air ambulance, essentially a flying ICU, staffed with a doctor and nurse, to fly you to a major medical center in Lima or Miami, or wherever the best care can be provided. Without this coverage, you or your family would be trying to figure this out on your own, frantically calling air ambulance companies and being asked for a credit card number. The cost? An air ambulance from South America to the US can easily cost over $100,000. From Asia, it can push $250,000. Medical evacuation coverage isn't a luxury. It's an absolute necessity for anyone traveling outside of major, first-world cities. And there's a grim but essential cousin to this benefit: repatriation of remains. It's something we never want to think about, but if the worst happens, this benefit covers the complex and incredibly expensive process of transporting a deceased person's body back home. The logistical and legal hurdles are immense, involving embassies, local authorities, and specialized transport. The cost can run into the tens of thousands of dollars. Having this coverage means your grieving family won't have to navigate this nightmare alone, while also facing a crushing financial burden. Another line item you'll see is accidental death and dismemberment, or AD&D. This is different from your medical coverage. It doesn't pay doctors or hospitals. Instead, it pays a lump sum of cash directly to you or your beneficiary if you die or lose a limb, your sight, or hearing as the result of an accident during your trip. The payout amounts can vary from $10,000 to $100,000 or more. It's a bit like a mini life insurance policy that's only active while you travel. Now we need to talk about the single most important, most confusing, and most frequently denied aspect of travel health insurance: pre-existing medical conditions. This is the minefield. Pay very close attention, because understanding this can be the difference between your claim being paid or denied. First, what is a pre-existing condition? The definition is much broader than you think. It's not just a chronic illness like diabetes or heart disease. A pre-existing condition is typically defined as any illness, injury, or medical condition for which you received treatment, took medication, were diagnosed, or even just had symptoms in a specific period before you bought your insurance. This period is called the look-back period, and it's usually 60, 90, or 180 days. Let me give you an example. Let's say you have high blood pressure, and it's been stable for years on the same medication. 61 days before you buy your travel insurance, you go for a routine checkup, and your doctor says, "Everything looks great. Let's just slightly tweak your dosage to be safe." Boom! In the eyes of the insurance company, that change in medication makes your high blood pressure an unstable, pre-existing condition. If you then have a heart attack on your trip, they could look at your records, see that change within the look-back period, and deny your claim, arguing it was related to an uncovered pre-existing condition. It's that strict. So, are you just out of luck if you have any medical history? No. This is where you find the secret weapon of travel insurance: the pre-existing condition exclusion waiver. This waiver is gold. If your plan includes it, it essentially erases the pre-existing condition exclusion, meaning you can be covered for medical issues that would otherwise be rejected. But you have to qualify for it. And there are usually two very strict rules. 1, you must be medically stable to travel when you buy the policy. 2, and this is the most critical part, you must purchase your insurance policy within a short time window, usually 14 to 21 days, of making your very first payment for your trip. Your first payment could be your flight, your cruise deposit, or your tour booking. The clock starts ticking the second you pay that first dollar. If you wait until the day before your trip to buy insurance, you will almost certainly not be eligible for the waiver. This is a powerful incentive to buy your insurance early, right after you book your trip. It's the single most important thing you can do to ensure you're fully covered. Some policies, particularly those for travel within the US or for non-US citizens visiting America, might not offer a waiver. Instead, they might cover something called the acute onset of a pre-existing condition. This is different. It covers a sudden, unexpected emergency flare-up of a stable condition that occurs without warning and requires immediate medical attention. For example, a person with stable asthma who has a sudden life-threatening asthma attack. It's a helpful benefit, but it's much more limited and far more open to interpretation by the insurance company than a full waiver. So when you compare plans, don't just look for the words pre-existing conditions. You need to dig deeper. Does it offer a full waiver? What are the requirements to get it? If not, does it cover the acute onset? Understanding these details is absolutely non-negotiable for getting a plan that will actually protect you when you need it most. Now let's talk about the one thing that can turn a medical problem into a life-altering financial catastrophe. It's the single most expensive thing that can happen to you on a trip, and it's something most people either ignore or completely misunderstand in their policy. I'm talking about emergency medical evacuation. This isn't about getting an ambulance to the local hospital. This is about getting you out of a place that cannot help you into a place that can. And the difference between a good policy and a bad one here isn't just about money. It can be the difference between life and death. Imagine this. You're on the trek of a lifetime in the remote mountains of Nepal. You're miles from the nearest road. You slip on a patch of ice and you hear a sickening crack. Your leg is broken. Badly. The local village has a small clinic, but it's staffed by one nurse with a box of bandages and some aspirin. They can't set a complex fracture. They don't have an operating room. They can't save your leg. You need to get to a modern hospital in Kathmandu, and you need to get there now. The only way out is by helicopter. So you make the call. How much do you think that helicopter ride costs? A few $100? $1,000? Try $10,000 to $25,000. Or more. And that's a relatively short flight. What if you're on a cruise ship in the middle of the Pacific and have a heart attack? You need a private medical jet with a full medical team on board to fly you to Hawaii or San Diego. Now you're looking at a bill for $50,000, $80,000, even $150,000. This isn't an exaggeration. These are real numbers. And without the right insurance, that bill is yours. This is why understanding your medical evacuation coverage is paramount. It's not a nice-to-have feature. It's a critical lifeline. When you're looking at a plan, the first thing you need to check is the coverage limit. You'll see plans that offer $25,000 in evacuation coverage. And you might think, great, that sounds like a lot of money. But as we just established, that might not even be enough to get you out of the mountains. A serious medical flight can burn through that amount before you've even left the country. Look for plans with a minimum of $100,000 in coverage. The best plans will offer $500,000, $1 million, or even unlimited evacuation coverage. The higher, the better. This is not the place to skimp, but the dollar amount is only half the story. The real devil is in the details of the policy wording. You need to look for two magic phrases. The first is transport to the nearest adequate medical facility. Every policy has this. But what does adequate mean? This is where cheap plans get you. Their definition of adequate might be a hospital that can stabilize you, but isn't equipped for the complex surgery you actually need. It might be a clean facility, but one where nobody speaks English and you're miles away from your family. They fulfill their obligation by getting you to the nearest place that meets their bare minimum standard, and that's it. You're left to figure out the rest. This is why you need to look for the second, more powerful phrase. Transport to your hospital of choice, or repatriation to your home country. This is the gold standard. This means the insurance company won't just dump you at the nearest clinic. They will arrange and pay for your transport all the way back home, to a hospital you trust, with doctors you know, and your family by your side. Think about the difference. Lying in a foreign hospital bed for weeks, confused and alone, versus recovering in your hometown. The peace of mind that comes with this single benefit is immeasurable. It's a feature typically found in more comprehensive plans, and it is worth every single penny. Let me tell you about a traveler named Mark. He was a 62-year-old retiree on a celebratory trip to a small island in the Caribbean. He suffered a stroke. The island clinic was able to stabilize him, but they had no neurologist, no advanced imaging, no stroke rehabilitation unit. His cheap insurance policy only covered transport to the nearest adequate facility, which was a larger, but still limited, hospital on a neighboring island. His family had to fight for days, eventually paying tens of thousands of dollars out of their own pocket to arrange a private medical flight to get him back to Miami for the specialized care he desperately needed. If his policy had included repatriation to his home country, that flight would have been covered. It would have been arranged by experts. It would have saved his family from incredible stress and financial ruin during the worst week of their lives. And this brings us to a related and admittedly grim topic that's often bundled with medical evacuation: repatriation of remains. Nobody wants to think about this. But if the worst should happen, dealing with the logistical and legal nightmare of bringing a loved one home from a foreign country is the last thing a grieving family should have to endure. It's a complex, bureaucratic, and incredibly expensive process, often costing $10,000 to $15,000 or more. A good travel insurance plan will handle everything. They will coordinate with the local authorities, manage the complex paperwork, and cover the costs of transportation. It's a heartbreaking thing to consider, but ensuring this is in your policy is a profound act of love for the people you'd leave behind. So, when you're comparing plans, here's your evacuation checklist. First, what is the maximum dollar amount? Aim high, at least $100,000, but preferably $500,000 or more. Second, where will they take you? Look for the magic words: home country or hospital of choice. Don't settle for just nearest adequate facility. Third, what are the exclusions? This is huge. Many plans will not cover you if you need evacuation, because of an injury you sustained while doing something they consider a hazardous activity. And their definition of hazardous can be surprisingly broad. We're not just talking about wingsuit flying. It could be scuba diving, rock climbing, or even skiing on a resort slope. If you plan on doing anything more adventurous than walking around a city, you absolutely must check if you need to buy an adventure sports rider or a specialized plan that covers these activities. Otherwise, that helicopter rescue after your skiing accident is coming out of your pocket. Finally, you need to understand how the process actually works. You don't call a helicopter yourself and then send your insurance the bill. Every reputable insurance provider operates a 24/7 emergency assistance hotline. This number is your lifeline. You or someone with you calls this number and they take over. They have a global network of doctors, translators, and logistics experts. They will consult with the local doctors, determine the best course of action, and then deploy the resources needed to get you to safety. They are the ones who arrange the helicopter, the air ambulance, and the medical crew. Your job is to have that number saved in your phone, written down in your wallet, and to call them the second you are in serious trouble. The peace of mind this provides is hard to overstate. Knowing that a team of world-class experts is just one phone call away, ready to manage a crisis anywhere on the planet, is one of the most valuable things you are buying. It transforms your insurance policy from a piece of paper into a powerful global safety net. So before you finalize any plan, dig into that medical evacuation section. Don't just glance at the headline number. Read the fine print. Understand the definitions. Are you covered for a flight all the way home? Are your adventurous activities included? Is the coverage limit high enough to handle a true worst-case scenario? Answering these questions now can save you from a $100,000 mistake later. But let's be honest, for most of us, it's not the dramatic helicopter rescue we'll need. It's something far more common but just as confusing. How do you actually use this insurance for a simple doctor's visit? What's a deductible? What's coinsurance? And how do you avoid paying thousands out of pocket for a twisted ankle? That's exactly what we're breaking down next. Alright, let's imagine the scene. You're hiking in the stunning mountains of Peru, you take a wrong step on a loose rock, and you feel that sickening sharp pain in your ankle. It swells up instantly. You know you need to see a doctor. This isn't a life or death emergency, but it's a real deal medical situation in a foreign country. What happens now? Your first instinct might be to panic about the cost. But your first action should be to call the 24/7 assistance number on your travel insurance card. Do not lose this number. Put it in your phone, write it on a piece of paper in your wallet. This call is your lifeline. They can help you find a reputable, English-speaking clinic, and sometimes even arrange direct payment so you don't have to pay out of pocket. But let's say you go to the clinic, you get an x-ray, a diagnosis of a bad sprain, a brace, and some pain medication. A few days later, you get the bill. It's for $1,000. Now, we finally get to the heart of how this insurance actually works. This is where three critical terms come into play: the deductible, the coinsurance, and the out-of-pocket maximum. Understanding these three things is the key to not getting a nasty financial surprise. First up is the deductible. Think of the deductible as your entry fee. It's the amount of money you have to pay for a covered medical expense before your insurance company starts to pay for anything. It's your share of the risk. So let's look at your policy. Let's say you chose a plan with a $250 deductible. On that $1,000 bill for your sprained ankle, you are responsible for the first $250. You pay that, and only then does the insurance company even look at the rest of the bill. So, you've paid your $250 deductible. What happens to the remaining $750 of that bill? This is where the second term, coinsurance, kicks in. Coinsurance is cost sharing. After you've met your deductible, you and the insurance company split the rest of the bill based on a pre-agreed percentage. A very common split is 80/20. This means the insurance company pays 80% of the remaining cost, and you pay 20%. So let's do the math. The remaining bill is $750. The insurance company pays 80% of that, which is $600. You pay the other 20%, which is $150. So, for your $1,000 sprained ankle, your total cost out of your own pocket is your $250 deductible, plus your $150 coinsurance payment. That's a total of $400. It's not nothing, but it's a heck of a lot better than $1,000. Now, you might be thinking, what if this wasn't a sprain? What if it was a serious break requiring surgery? What if the bill was $50,000? That 20% coinsurance could still be a huge, terrifying number. A 20% share of a $50,000 bill is $10,000. This is where our third and most important term comes in to save you: the out-of-pocket maximum. The out-of-pocket maximum is your financial safety net. It is the absolute most you will ever have to pay for covered medical expenses in a policy period. Once you've spent that amount on your deductible and your coinsurance payments combined, the insurance company pays 100% of all covered costs for the rest of the policy term. Let's look at a plan with a $250 deductible, 80/20 coinsurance, and a $5,000 out-of-pocket maximum. Let's say you have a catastrophic injury, and the medical bills total $100,000. The math seems scary, but watch how the out-of-pocket max protects you. First, you pay your $250 deductible. Now there are $99,750 left. Your 20% share of that would be $19,950. But wait, you have that $5,000 out-of-pocket maximum. Your total spending is your $250 deductible plus your coinsurance payments. Once that number hits $5,000, you stop paying. So, you pay your $250 deductible, then you pay $4,750 in coinsurance, and once you hit that $5,000 limit, you are done. The insurance company picks up the remaining $95,000. The out-of-pocket maximum is what separates a manageable expense from personal bankruptcy. It is, without a doubt, one of the most important numbers to look at when you're comparing plans. So, how do you use this knowledge to pick the right plan for you? You need to understand the trade-off. Generally speaking, plans with lower monthly premiums, the amount you pay to buy the policy, will have higher deductibles and higher out-of-pocket maximums. They're cheaper upfront, but you take on more financial risk if something actually happens. Conversely, plans with high monthly premiums usually have very low, or even $0 deductibles and lower out-of-pocket maximums. You pay more upfront for peace of mind, knowing your financial exposure is limited if you need to use the insurance. Which is right for you? It depends on your risk tolerance and your health. If you're young, healthy, and on a tight budget, a higher deductible plan might make sense. You're betting you won't need it, but it's there for a true catastrophe. If you have a pre-existing condition, or you're traveling with kids, or you're just more risk-averse, paying a higher premium for a lower deductible and a lower out-of-pocket max might be the smarter move. It gives you more predictable costs. When you're on a comparison website, don't just look at the price. Look at these three numbers. Set the filters. Compare a $250 deductible plan to a $1,000 deductible plan. See how it changes the price and the coverage. Look for the out-of-pocket maximum. Some cheaper, less reputable plans might have an incredibly high one, or in some cases none at all. A plan with no out-of-pocket maximum is a massive red flag. It means your financial liability is potentially unlimited. You should avoid these plans at all costs. Now, the final piece of the puzzle is the claims process itself. This is where the rubber meets the road. For most international travel insurance, you should expect to pay for smaller medical expenses, like a simple doctor's visit or a prescription, out of your own pocket first. Then you submit a claim to the insurance company for reimbursement. This is why it is absolutely critical to be your own advocate. Get and keep every single piece of paper. The doctor's report, the itemized bill, the receipt showing you paid, the prescription from the pharmacy, get it all. Take pictures of everything with your phone immediately as a backup. Don't wait until you get home. Most insurance companies have an online portal or a mobile app where you can start the claims process right away. The sooner you file, the sooner you'll get your money back. In the case of a major hospitalization, the 24/7 assistance team will often work to arrange direct payment with the hospital, but for the day-to-day stuff, you should be prepared to pay up front and get reimbursed. By understanding the interplay between the deductible, coinsurance, and your out-of-pocket maximum, you're no longer just guessing. You can look at two plans side by side and make an intelligent, informed decision based on your budget and your tolerance for risk. You can see exactly how the policy will respond when you actually need it, whether it's for a minor sprain or a major medical emergency. So you've mastered the medical side. You know how to avoid a 5-figure hospital bill for a broken bone. But what happens if you never even make it to the airport? What if a family emergency, a sudden illness, or even a natural disaster forces you to cancel your entire $10,000 dream trip? Is all that money just gone? We'll cover the insurance that saves you from that nightmare. Next, the answer for the savvy traveler is a resounding no. That money isn't gone. It's protected by what are arguably two of the most important and often misunderstood coverages in the travel insurance world: trip cancellation and trip interruption. These are the financial guardians of your journey, the safety net that catches you when life decides to throw a wrench in your perfectly laid plans. Let's start with the big one, trip cancellation. This is the coverage that kicks in before you leave home. You've booked the flights, paid for the non-refundable hotel in Paris, and pre-purchased those high-speed train tickets. Your trip is a significant financial investment. Trip cancellation insurance is designed to reimburse you for those prepaid, non-refundable expenses if you have to cancel your trip for a specific covered reason. And that phrase, covered reason, is the absolute key. This isn't a get-out-of-jail-free card because you changed your mind. Standard trip cancellation policies operate on a named perils basis, meaning they list out exactly what situations they will cover. The good news is that the list is usually quite comprehensive. Think about the most common trip-ruining scenarios. The most frequent covered reason is the unforeseen sickness, injury, or death of you, your traveling companion, or a close family member. Imagine you're 2 weeks away from your dream safari in Kenya, and your father has a sudden heart attack and needs surgery. You need to be there for him. With trip cancellation, you can cancel the trip, focus on your family, and file a claim to get back the thousands of dollars you spent on non-refundable safari lodges and flights. Without it, you'd be facing not only a family crisis but also a massive financial loss. But it goes far beyond that. What if a hurricane is barreling towards your Caribbean resort, and the airline cancels all flights? That's a covered reason. What if your home is rendered uninhabitable by a fire or a flood right before you're supposed to leave? Covered. What if you're laid off from your job after you've already paid for the trip? Many policies cover that. Terrorist incident in your destination city? Covered. Called for jury duty? Believe it or not, that's often a covered reason too. Another huge one is the financial default of your travel supplier. Let's say you booked a once-in-a-lifetime river cruise, and the cruise company declares bankruptcy a month before you sail. All that money you paid them could vanish. But if your policy includes supplier default, you get your money back. This is why you should always buy your insurance from a third-party provider, not from the cruise line or tour operator themselves. If they're the ones who go bankrupt, the insurance they sold you might be worthless. So, trip cancellation is your shield before you go. But what happens if you're already there? You're 1 week into a 3-week tour of Southeast Asia. You're standing in front of Angkor Wat, having the time of your life when you get a call from back home. A family member has had a serious accident. You have to go home right now. This is where trip interruption takes over. It's the sister coverage to trip cancellation, and it's just as vital. First, it reimburses you for the unused portion of your trip. You paid for 3 weeks but only got to use 1. Trip interruption will reimburse you for the value of those 2 lost weeks, the prepaid hotels, tours, and internal flights you'll have to miss. But here's where it becomes a true lifesaver. It also covers the cost of your last-minute, one-way flight home. Anyone who has ever tried to book an international flight for the next day knows that it can be astronomically expensive, often costing more than your original round-trip ticket. Trip interruption covers this reasonable additional transportation cost to get you back home quickly. It might even cover the cost to get you back to your destination to resume your trip if it makes sense. So, trip cancellation protects your investment before you go. Trip interruption protects you and your wallet during your trip. Together, they form a powerful defense against the unexpected. But you might be thinking, what if my reason for canceling isn't on that list? What if my pet gets gravely ill? What if I have a major falling out with my traveling companion and just can't imagine spending 2 weeks with them? What if I'm just anxious? There's a new project at work. Or I'm worried about a vague global event that isn't a named terrorist incident. Standard policies won't cover these situations. For that, there is the ultimate upgrade. A cancel for any reason policy, or CFAR. This is exactly what it sounds like. It allows you to cancel your trip for literally any reason. A reason that is not otherwise covered by your policy, and still get a significant portion of your money back. Now, CFAR comes with some very specific rules and limitations. It's not a standard feature. It's a time-sensitive add-on that you have to purchase, typically within 14 to 21 days of making your very first trip payment. You can't wait until the week before your trip when you're feeling nervous and then decide to add it. The insurance companies need you to buy it when the risk is still low. Second, if you do use the CFAR benefit, you won't get 100% of your money back. The reimbursement is usually between 50 and 75% of your non-refundable trip costs. The insurance company is sharing the risk with you. They're saying, we'll cover half or 3/4 of your loss, even if it's for a reason we don't normally cover. And third, you usually have to cancel your trip no later than 48 hours before your scheduled departure. You can't just not show up at the airport and expect a check. So, is CFAR worth the extra cost? It depends entirely on your situation and your peace of mind. If your trip is incredibly expensive, like a $20,000 Antarctic expedition, paying a bit more for the ability to recoup 75% of that for any reason might be a brilliant investment. If you have a precarious situation at home, an elderly parent with fluctuating health, a job that's unstable, or a child prone to last-minute issues, CFAR provides a level of flexibility that standard policies just can't match. It transforms your non-refundable deposits into a partially refundable safety net. Let's put it all together. You're booking that $10,000 family trip to Italy. You buy a comprehensive travel insurance plan right after you pay your initial deposit for the flights. Scenario A. A month before you leave, your daughter breaks her leg and the doctor says she can't fly. You cancel the trip. Trip cancellation kicks in because of a covered injury, and you are reimbursed for the full $10,000 in non-refundable costs. Scenario B. You make it to Rome, but after 3 days, you get a call that your business partner back home has had a stroke, and you need to return immediately to manage a crisis. You cut the trip short. Trip interruption reimburses you for the unused portion of your prepaid hotels in Florence and Venice, and it pays for your exorbitant last-minute flight from Rome back to Chicago. Scenario C. A week before the trip, everything is fine medically and with your job, but you're having a massive fight with your spouse, and the idea of being trapped together in Italy sounds like a nightmare. Or your longtime dog sitter cancels, and you can't find a replacement you trust for your beloved, aging dog. These are not covered reasons on a standard policy, but because you bought the CFAR upgrade, you can cancel the trip, and instead of losing the full $10,000, you get 75% of it, $7,500 back. You still lose some money, but it's a far cry from losing everything. Understanding these three coverages, trip cancellation, trip interruption, and the cancel for any reason upgrade, is what separates a prepared traveler from one who is gambling with thousands, or even tens of thousands of dollars. It's about recognizing that the world is unpredictable, and building a financial fortress around your hard-earned vacation. We've now covered the core components of a great travel insurance policy: the life-saving medical and evacuation benefits, and the wallet-saving cancellation and interruption benefits. But knowing what these are is only half the battle. How do you actually sift through the dozens of policies online, each with its own confusing jargon and fine print? How do you compare apples to apples and find the one that offers the best value and protection for your specific trip? There are hidden traps and policy limits that can make or break a claim. We'll expose those traps and give you a simple framework for making the perfect choice in our final part. So let's pull back the curtain. When you're staring at a comparison website with 10 different policies, they all start to blur together. They have fancy names like Voyager Secure or Trekker's Choice. But what are you actually buying? The key isn't to read every single line of every policy. The key is to know exactly what to look for. We're going to use a simple 3-step framework. Think of it as your personal insurance decoder ring. The 3 steps are the core numbers, the hidden exclusions, and the value equation. Let's start with the core numbers. This is the big print, the stuff they want you to see, but people often misunderstand what it means for them. There are 3 numbers that matter more than anything else: the overall maximum, the deductible, and the emergency evacuation limit. First, the overall maximum. You'll see plans offering $50,000, $100,000, $500,000, even $1 million in medical coverage. And your first instinct, especially for a short trip to a safe country, might be to say, $50,000 is plenty. I'm just going to Paris for a week. This is the first and most dangerous trap. A serious medical event abroad doesn't follow a budget. Let's say you slip on a wet cobblestone street and suffer a complex leg fracture. You need surgery with implanted hardware, a multi-day hospital stay, and consultations with a specialist. In many Western European countries, that bill can easily soar past $50,000. And if something truly catastrophic happens, a serious car accident, a sudden stroke, you could blow through a $100,000 limit before you're even stable enough to fly home. The cost difference between a $50,000 plan and a $250,000 plan is often negligible. Maybe the price of a few cups of coffee, but the difference in protection is life-altering. My rule of thumb? For international travel, I never consider a plan with less than $100,000 in medical coverage, and I strongly prefer $250,000 or more. It's the cheapest peace of mind you can buy. Second core number, the deductible. This is what you pay out of pocket before the insurance company pays a dime. You'll see options from $0 up to $1,000 or more. The trap here is thinking a $0 deductible is always the best choice. A zero deductible plan will have a higher premium. You're paying more upfront for the convenience of not having to pay anything if you make a claim. A plan with a $250 deductible will be cheaper. So how do you choose? Ask yourself this. Are you buying this insurance for a minor inconvenience or for a major catastrophe? If you get a bout of food poisoning and need a quick doctor's visit that costs $150, are you okay paying that yourself to save money on the premium? Or do you want the insurance to cover every little thing? If you're planning a rugged, month-long trek through Southeast Asia, a zero deductible plan might be worth it, since the chances of a minor incident are higher. But for a week in Rome, a $250 deductible is a reasonable trade-off for a lower upfront cost. You're still completely protected from that $50,000 leg fracture. You just have to cover the first small piece of it yourself. The third and most critical core number, emergency medical evacuation. This is not the same as your overall medical limit. This is a separate bucket of money dedicated to getting you from an inadequate medical facility to one that can properly treat you. This could mean a helicopter ride off a mountain in the Alps or a private, medically staffed jet to fly you from a remote island back to a major hospital in the United States. These services are astronomically expensive. A medical evacuation flight across the Atlantic can easily cost over $100,000. This is non-negotiable. Your policy must have robust medical evacuation coverage. Do not even consider a plan with less than $500,000 for this benefit. $1 million is better. Skimping here is like buying a race car but leaving out the brakes. When you need it, you really need it, and the cost is staggering. Okay, that's step 1, the core numbers. Now for step 2, and this is where the real detective work comes in, the hidden exclusions. This is the fine print. This is where a cheap policy reveals why it's so cheap. The single biggest area to investigate is coverage for your planned activities. The standard policy you buy is designed for a tourist who plans to visit museums, eat at restaurants, and walk around a city. It is not designed for an adventurer. Are you planning to ride a scooter in Vietnam? Many policies specifically exclude injuries from two-wheeled motorized vehicles. Are you going scuba diving in Belize? Most basic plans won't cover you if you dive below a certain depth, or if you're not certified. Skiing, rock climbing, bungee jumping, even trekking at high altitudes, these are almost always excluded from a base-level policy. You need to look for a plan that either includes these activities or allows you to add an adventure sports rider for an extra fee. Buying a plan that excludes what you intend to do is literally throwing your money away. The other massive hidden exclusion is for pre-existing medical conditions. This is a minefield. Most policies have something called a look-back period, which can be anywhere from 60 days to a full year. They will look back at your medical records for that period before you bought the policy. If you had any change in your condition, a new medication, a new symptom, a new treatment for something like high blood pressure or diabetes, they can refuse to cover any claim that they decide is related to that condition. This is how people with stable, managed conditions get their claims denied. The solution? You need to find a plan that offers a pre-existing medical condition exclusion waiver. To get this waiver, you typically have to buy your policy within a short window, usually 14 to 21 days, after making your first trip payment. This is huge. It means that if your stable condition unexpectedly flares up overseas, you're covered. If you have any ongoing health concerns at all, this waiver is not a luxury. It's an absolute necessity. Now we're ready for the final step of our framework, the value equation. Notice I didn't say the price. Price is what you pay, value is what you get. The cheapest plan is almost never the best value. Let's put it all together with a real-world example. Imagine you're planning that 2-week trip to Thailand. You're going to explore Bangkok, visit some temples, and then spend a week on the islands where you plan to rent a scooter and maybe try an introductory scuba dive. You go to a comparison site and find 2 plans. Plan A costs $40. It looks great. It has a $100,000 medical maximum and a $250 deductible. But you use the framework. You dig into the details. You discover its medical evacuation limit is only $100,000, way too low. Then you read the fine print and see it explicitly excludes any injuries from mopeds or scooters, and any scuba-related accidents. This $40 plan is completely useless for the trip you've actually planned. It offers zero value. Plan B costs $85. It's more than double the price, but you apply the framework. It has a $500,000 medical maximum, the same $250 deductible, but its medical evacuation coverage is a full $1 million. And most importantly, it includes an adventure sports package that explicitly covers scooter use and recreational scuba diving. For an extra $45, you have gone from a policy that is essentially worthless for your needs to one that is rock solid. That is the value equation. You're not just spending an extra $45. You are buying real, tangible protection against a potential $200,000 catastrophe. So, to recap, here is your final checklist for comparing any travel health insurance plan. 1. Check the core numbers. Aim for at least $250,000 in medical, a deductible you're comfortable with, and no less than $500,000, preferably $1 million, in medical evacuation. 2. Hunt for the hidden exclusions. Does the policy cover all of your planned activities? Do you need an adventure sports rider? If you have a pre-existing condition, does it offer a waiver, and have you purchased it within the required time frame? And 3. Calculate the value equation. Don't just look at the price tag. Look at what that price buys you in terms of real, usable coverage for your specific itinerary. Armed with this framework, you can now look at any list of policies and confidently cut through the noise. You can use comparison websites not as a confusing menu, but as a powerful tool to filter and find the 1 or 2 plans that truly fit your needs. Choosing the right insurance isn't the most glamorous part of planning a trip, but it is the single most important thing you can do to protect yourself and your family. It's the foundation upon which all your incredible travel memories are built. Because the ultimate goal isn't just to travel the world. It's to do so with the confidence and peace of mind that no matter what happens, you're prepared, you're protected, and you're ready for the adventure. Travel smart. Travel safe.